Yeah.
Hey, everyone, welcome back to another episode of Deep Dive with OA. I'm Omar Abedin, currently head of VC investments at TMT Ventures. And today, for the very first time, we have a return guest, and you will recognize him from an earlier episode we recorded just a little while ago. Matt Burris, welcome back to the show.
Thanks for having me, Omar. It's great to be back.
It's fantastic. So Matt is a partner at Venture Studio Associates, and he's also a partner at Savvy Tinker Studios. And at this point in time, Matt is my go-to guy for everything studio related. So I reached out to Matt. I said, listen, I'm getting a lot of questions about the business models of studios, and can you help me to kind of unravel this in simple language for the audience? And Matt was kind enough to carve out some time again so quickly. So Matt, let's jump into it. Before we get to the financial models, though, just help our audience quickly understand what are some of the advantages and disadvantages of being part of a studio and investing in a studio.
Sure. One way to look at a studio is that they're the ideal co-founder in a lot of ways. If I look for a co-founder, I would love, like, my wildest dream for a co-founder is someone that shows up, they've got a team with them that's going to jump in. I don't have to pay them. I'm not giving them extra equity. They're already there. They're going to do the work. They know how to do the work, right? They're familiar with the ups and downs, the chaos of that early stage startup reality. They've got a playbook. They know how to go from that early idea, maybe all the way up to growing the revenue stream, customer base of the startup. So we don't have to go reinvent the wheel and build all these processes from scratch. And they show up with capital. Like, generally, it's, oh, hey, you and I, let's partner and go build a startup, right? We have no money, so we're just spending our savings. If a co-founder showed up and, like, you know what, I got the first million, or I got the first $250,000. Oh, what? we've got budget.
Please come in. Please come in. Can I get you some tea?
Oh, yes. Like, I don't have to just spend from my savings. This is phenomenal. Obviously the cap table has to work. Reality is a reality. Follow-on investors want to see a cap table they can invest in. Yeah. So that has to still work. But, showing up with all those resources means I don't have to spend as much time trying to fundraise. And anybody who's been down that road knows how much effort that takes, knows how much of a distraction that could be, especially in the beginning when you're trying to figure out what should we actually build that makes sense that customers are going to fall in love with. I want to spend my time answering that question really, really well, not being distracted by trying to make sure we have enough money to carry on. And so having that as a huge force multiplier in the beginning, because focus is just incredibly valuable. From an investor standpoint, the process that a studio puts in place around building companies and the discipline they bring in making sure that we should actually continue building a particular company is a huge value add in just de-risking the entire startup process. If we look at an ideal world, all of us as founders should go out and make sure that investors would be interested in what we're building, that they haven't invested in a whole bunch of similar stuff and the landscape is just too crowded to consider us. Do we do that? Yeah, no, we don't. That's just too time consuming. It's a distraction. We should look at who the potential acquirer is and make sure there's at least two, so that when we get to the point of maybe being an acquisition target, there's a nice bidding war. We don't do that as founders, as entrepreneurs. It's just, we got to cut, and that's below the line. But studios can build that very quickly into their process. And so they can look at it the high level, almost take like an Overwatch position where the founder and the team is really working in the weeds, looking at the trees in the forest, and the studio's looking at the terrain, going, we got a cliff over here, we got some mountains over here, but there's a nice path this way. Let's go that way. So hugely valuable, done right. And I think that's always the caveat in anything in the startup world. if it's not done right, there's problems.
Yeah, for sure. Okay, awesome. So let's dive into the business models of studios, and let's look at it from an investor standpoint. Why are venture studios more or less attractive to potential investors, especially at the early stage?
At the earliest stage of a studio, there's a kind of a unique opportunity for investors, and it doesn't exist past with Fund 3 for sure, not going to be there. Fund 2, it's rare. So it's really that first time a studio raises, you have the option sometimes, not all studios do this, but many put those investors effectively as GP stake owners. That's a term from private equity. What it really means is you own a piece of everything the studio does forever. That's it. And that's really, really interesting, because how most studios end up evolving is they might start as a holding company or a dual entity model. The dual entity model lets you layer in a traditional venture fund and then do another venture fund and then do another venture fund. Well, that holding company is still there. The holding company typically gets the common stock as the co-founder share that the studio takes. That's interesting, because if you're an investor in that holding company, every time you start a new fund, you start a new batch of companies. There's no new investor that went into the holding company. So whoever's still an investor there gets to ride on Fund 2 and Fund 3 and Fund 4 without putting more money in.
Right.
So yeah, it's basically the potential for permanent returns. It's almost an annuity model in that respect. Obviously much higher risk than a true annuity. And let's be honest, building a studio, just like building a venture fund or building an accelerator and trying to operate it and continue to grow it, it is high risk. And the investors that are in early days probably deserve to get a little bit more than what future investors are going to have as an investment option. It's really interesting. It's really attractive, but it's also only a good fit for angel investors, family offices, high net worth individuals, because when you're talking about that GP stake investment, there's typically not going to be an exit. You just get continual returns.
Yeah, it's an open fund with rolling returns.
Absolutely. And I need to release the model at some point. I literally have built a GP stakes investment model so you could compare investing in a traditional venture fund versus a GP stake in a studio, and the numbers are really good.
Well, talk about those numbers a little bit. Do you want to put the model up on screen? Do you want to give our
no, I gotta fix it. Like I try to build, when I make models, I try to build a lot of the variables in. One of those variables right now is broken, so it doesn't accurately reflect some of the nuance. And a lot of it is because things like so you have a holding company, you've got a venture fund. Fees, where are the fees going? Are they going back to the holding company? Okay, do the investors in the holding company get a percentage of fees? Right. So there's all these little nuances that go in that make it a little different. But the interesting thing is, typically when you take a GP stake, you're going to get very, very similar returns like you invested in a venture fund, especially that first one. Once you get that venture fund riding alongside, the venture fund is going to take a good chunk of the ownership that the original holding company would have had all of. So you don't get the same return on, say, Fund 2 that you had on Fund 1 as a GP stake owner. You didn't put any money in. Any money in. You obviously generally have the option to invest in and follow on, but you don't have to. And so really the bet you're making is that this team is going to continue doing the studio model, that this is something that they love, they're passionate about, they're good at. And as long as they're doing like Fund 1, you're still in the money. You're doing good. The second Fund 2 is there. It just, the MOIC just keeps going up. Like you're just going to keep making more and more money without putting any more money in, and it's a good time.
So basically, we're talking about two separate legal entities, right? We're talking about the studio itself, and then we're talking about a venture fund that runs in parallel with the studio.
Yes, and unfortunately, sometimes it's a lot more than two legal entities, but we often simplify it because it's really what it boils down to. Where
Right.
you end up with more than two legal entities is for things like tax purposes, the regulatory stuff, because the staff in a studio, you want to give them a little upside on the companies you build, but how you handle that is generally not by providing them all individual equity on the cap table of each company you create, because it makes it, one, a very messy cap table. There
Yeah.
can, depending on the region you're operating in, there can be some regulatory issues with doing that. So the legal structures can get messy. The simplified version is absolutely, it's a holding company. We build companies out of the holding company. So they're the co-founder, get a lot of common stock there. The fund makes that investment in each company once it gets a little traction and is being built. Fund usually, like a standard venture fund, right? Takes preferred equity. That's it. What you do get in the studio world is often the fund will also make the first investment into the studio. Doesn't take ownership in the studio. Sometimes, but rare, because that studio, the holding company, should last forever. You don't want to shut it down all the time. And funds have a 10-year life. So it needs a way to exit. So often that first investment is just to say, hey, I know you as the studio are taking 10, 20, 30, whatever percentage equity you're taking as the co-founder stake, you're going to give the fund a portion of that common stock. And that really is beneficial from an operations perspective in the studio, because now you can cover a lot of your operations costs without keep raising into that holding company. The danger if you raise too much in the holding company and you're successful is if you've got more than 50% dilution in that holding company, generally what happens is the general partners running the studio look at each other and go,
Why are we doing
nobody on the cap table.
Yeah.
So
fair enough.
That's one of the things as an investor you want to look at as well. If you're going to invest in a studio in the early days, understand how they're looking at approaching that raise, because if they get too much dilution, the studio is probably going to dissolve at some point. So you want them to ideally stay less than 30%, but definitely less than 50%.
No, that makes sense. So in your view, what would be the ideal structure for a venture studio? Because, for example, one of the models that I've been kind of mulling over myself is a model in which I have practice leads. So, for example, there's a legal practice, there's a HR, marketing, business development, go-to-market, whatever. And each lead comes in almost as a partner in the business, right? Mm-hmm. So they're putting in some money into the business themselves. They're mm-hmm. buying their stake, and mm-hmm. Fine. It's a massively discounted stake. So if, let's say, the valuation of the studio is $10 million, and you're talking to investors for $1 million at 10% post-money valuation, then these guys would be getting a massively discounted stake, because they're not only buying into the company, they're also working in the company, right? So mm-hmm. they're actually delivering the services that the rest of the studio companies need. So how does that model work? Do you think that these people who are coming in and effectively becoming partners in the studio, they draw salaries? How do they work? What is the model that you think works best?
Yeah, I've seen a few different approaches to this, and I think when you have them come in as investors, that adds another level of nuance. So I'm going to ignore that at first, and we can come back to it. Sure. If I look at it just staff, right? Staff at all levels. This includes the GPs. How a lot of studios I've seen handle it is they take the stock that the studio gets, and whatever carry is going to come back in, and even sometimes the management fees if they want to do this, but fees usually go more towards ops. So usually the carry and the equity that's going to go towards employees, and they move it into a separate entity. It becomes a bonus pool. So rather than get direct stock, you treat it like a bonus pool that you invest in. And often studios will create a vesting structure that refreshes every year. So you basically, oh, you worked in the studio in 2023. Here's the vintage 2023 companies that we created, right? So you were here, however long you work in the studio, you get vesting in that vintage year. And then, you know, you've got 2024 and 2025. So you got kind of a rolling vintage.
Right. Okay.
The value for that from the studio perspective is you want your staff to stay with you. And this gives them incentive to stay because they would be giving up some or all of the vesting that, you know, that or the bonus pool that hasn't vested. So it can keep them in. You obviously want to balance this with sometimes your staff, you really, really want them to go with a particular startup because they happen to be the perfect person. So you don't want to penalize that. But you don't want your staff to always be going out with that next startup because now you're just like rehiring, your institutional knowledge is dropping off.
Continuous brain,
Yeah. It's not good. So it's this interesting balance. And that structure lets you navigate that balance fairly well. You know, layering in early investment is interesting because if those folks are like the right people to stay with the studio, then giving them a GP stake is great because they don't necessarily even have to stay as employees, staff members in the studio, right? Because they have often great networks or you wouldn't be bringing them in. They got great experience. So as long as they're going to remain a supporter and you can, you know, pull them in, that's a huge value add. And when I look at selecting investors to allow them into that permanent GP stake ownership in a studio, it's really that, are they going to provide long-term value? You know, a family office is amazing in that if it's, you know, if the family office, you know, built a lot of their wealth in a specific industry, which is also where you're going to be, like their network and the fact like they're so embedded in that industry, hugely invaluable as you continue to grow that studio. Same thing with any investor and any subject matter expert. So, you know, that's something I would definitely consider. And I've seen a few studios do that with, you know, building out very specific, you know, industry advisory boards, and that has worked very well.
Okay, interesting. So I guess the real difference is, if you can talk now about the partnership model within the studio, what do you feel about that? How do you think that works?
Which partnership model?
Oh, the one in which people are buying in to run specific verticals.
Oh, okay. So there's a lot of ways you can handle that one. You could make it just ownership, just in the whole studio itself. One thing I've seen done, especially as studios start growing and expanding, and there are not too many examples of this yet. There's a few studios that have either taken the next fund and raised it for a specific targeted vertical, like, you know, fintech, climate tech, whatever, and brought in or moved staff members over to become GPs in that particular fund. So that's one way to handle it. But yeah, early on, you're likely to be giving them either direct ownership into the studio itself or preferential, this gets more complicated on the accounting side, pieces of the companies within the areas that they're working.
Say more. Explain more.
I don't see too many of that second one because the accounting piece of this gets horrible.
Sure.
You know, I've seen a few groups try to create different mechanisms to really tie the ownership and the interests that they get in specific portfolio companies to the work that they do in those companies. Generally, the overhead on that is horrible. You end up with potentially people competing, but not in a friendly way inside the studio. So there's challenges. Like, one thing I always recommend any studio, keep it simple. Every time we try to add a little wrinkle, whether it's for investors, like, hey, we'll give them, you know, faster payback over here. We'll do this over here. It'll be better for them. The challenge is when you start looking at this and trying to you know, do the financial model or do the due diligence around it, you're adding a lot of complexity that's not normal. More complexity you add, the more likely investors are to say no. Just because it takes some more work. You know, simple is good. And it's hard for me to do this sometimes as well. I think we all suffer from that. But the more I've looked at a lot of these studio frameworks, the simpler you can keep the structure, the easier it is for everybody.
So in your view, what does that very simple structure look like?
You know, there's 3 legal structures to do a studio. I would try for all of them to keep the terms as close to standard as you possibly can. You know, when you're talking about the, you know, employee compensation packages, in the US especially, I like the bonus pool structure because it does simplify a lot of cap table issues. You know, a lot of these things will adjust regionally, so obviously you have to keep that in mind. I tend to try to avoid keeping getting staff on the cap table of portfolio companies directly, unless they're going to move into that company. It's just like I said, the accounting is a big challenge, and now you have people that are, you know, that staff in the studio that support one company and are on the cap table with one company, but they'll do a little work for another company. So how do you like do that? Like, just make it universal. You get everything. It makes it a little bit of a diversified investment, but it helps build a lot of the relationships at the studio level and also at the portfolio company level, because everybody that is there to make everybody succeed.
Interesting. Okay, very cool. So I guess my final question would be around taking a slightly elevated view of the studio model, trying to figure out what the difference is in terms of returns to investors who invest in studios versus, you know, typical VC funds or even angel investments in individual startups. Can you talk to that a little bit?
Well, I mean, there's some data out there on the performance of studios, and I'd say a good chunk of that data is probably from the original holding company, because you generally get a little bit more equity ownership when you start as a holding company than when you're in that dual entity model, right? Because you got a holding company, they get some common, you got the fund that takes the preferred. Well, now you've kind of split the, if you look at the high level, studio owns common and preferred. But as an investor, are you getting all of that or part of that? And so the returns will start shifting based on that. So your best returns are going to be from those early investments in studios, just from a strictly economic perspective. What you see from a lot of studios, of course, is as they mature over time, they build up better playbooks, their returns go up, their success, their batting average goes up, right? So there is that interesting trade-off, and we're going to have to wait for better data to really come out, more detailed data to really understand how that plays out, and what some of the nuances are that show up in the model, because there definitely will be, like the studio model, it's a, you know, high operations complexity model, and how you choose to execute those operations will make a really, really big difference. But you know, if I was looking at an investment into the studio asset class, you've got a few options. You've got that investment in that holding company early on. Love that GP stake if I can get it. Personally, that's where I would be trying to get as much as I can. You know, all things being equal, if an investment in the studio looks exceptional, so let's make that assumption. If I get that GP stake, I'm getting that GP stake. If I'm looking at it structured as a traditional fund entity with effectively no holding company, it's just run off the management fees, that's interesting. The dual entity model is also interesting. I like that if I can get more of the common. Because sometimes dual entity, especially if you come in as an anchor investor, you can still get a little piece of that GP stake. If I take a step back from a direct investment in a studio, now we've got a fund of funds. There's just a couple that are out there that are really focused on that studio asset class. You've got the Vault Fund. I know of a couple others that are starting right now to focus in that space, but there's not many. The nice thing about going that route is you're going to have a GP that really understands studios, has looked at investing in studios for a long time. They're going to be your guide through this world. If you're just starting, it's complex, right? Having that guide makes a lot of sense if you're investing at that level. Another option is investing in a venture fund that looks to invest primarily in companies that come out of studios, right? Studios have done a lot of de-risking of the companies that they build, and their returns can be really, really good. If you're going in as a fund and cherry picking the best ones, well, that becomes an interesting way to get exposure to the studio asset class. But again, generally, it's almost in smaller and smaller ticket sizes. Unless you're that first investor in, you got a small ticket in that early studio. Fund of fund is generally going to be a higher ticket. Venture fund, depending on the size, early ones right now are going to be relatively small. It's a small ticket to get a lot of diversification and a lot of exposure. So depending on where you are and what your experience is in this asset class, different ones are going to appeal. The downside to that initial holding company investment in one studio that gets a GP stake is it's one studio. It's diversified in the companies that it's building, but it's one studio, right? Investing in a fund of fund that invests in studios, you're in 10 different studios. Well, that's interesting, right? Are they getting GP stake? Like, how's different discussion? Like, how are their investments structured? And investing in a venture fund that backs companies that are built by studios, now you're getting diversification as well. You're not in the studio asset class directly, but you're benefiting from the quality of companies that they produce. So great ways to start understanding, does this asset class make sense? Different economics across all of those.
Fantastic. Just for many of our listeners who will be confused between common and preferred stock, could you explain why the studio generally gets common stock and what the benefits are, and why VCs generally get preferred stock and what the benefits are?
Yeah, so the studio is kind of a really interesting investor to have on the cap table from the common and preferred perspective. So if you and I start a company, we're going to split the shares. They're going to be common. Most companies, once they go public, it's generally just common stock. Some will have preferred. Preferred stock has different rules around it. So often they have the ability to get paid out first for a startup from the sale of a company. They might have certain protections in place. So the preferred might be in full control of, say, getting a loan above a certain amount. Very, very common provision for, seed and Series A VCs, for example, in the US. Like, hey, you want to get a loan above $250,000, you got to talk to us. Like, nobody else can authorize it. So, if you're the founder at a certain level, once you've got investors in that are taking that preferred stake, they become your boss. They can dictate some of what you can do.
Yeah.
And that's where investors like that as well, because they can get a preference and make sure that they can get enough return to protect their downside risk in the asset class. The studio is unique because often it'll take both. And when the studio takes both and the studio's on your board, they sit in a really interesting position because they have effectively the same equity the founder has in the common stock. And so they want to protect that equity and make sure it doesn't get diluted. They also have preferred equity. So they're on par with a lot of the other venture capital investors. They know how, VCs think, they know how the founder thinks, and they have a lot of exposure to this particular business. So they're a really interesting like buffer to have on the board, where you get a lot of VCs get exposure to a lot of different industries, but they don't spend a lot of time in this particular business. The studio helped build this particular business. So it can sit here and go, actually, I understand that, but it doesn't work in this industry for this reason. So founder, you don't need to go down and prove all of that to us.
All right.
Helpful to mitigate those distractions. And also when it comes time to, say, get that exit, the studio is there to help ensure that the common stock owners don't get too diluted because they own a piece of that too.
Very good. Thank you for that explanation. Is there anything else that we should know about the financial models around studios?
The biggest thing that I think as investors, when you start looking at the studio model, that triggers a really big red flag, is the studio model is a very, very high operations cost model. In a typical venture fund, you're 2 and 20, you're operating for 10 years, you get 2% of the fund each year. So 20% of that fund, say it's a 10 million fund, $2 million goes to operations costs. Okay. A studio, that might be 4 million, that might be 5 million. And so for a lot of investors look at it, they're like, why are we wasting this money on fees, right? You're just throwing the money away. That's not how this works in the studio model. That money goes to build those companies. So you're getting a lot of value for that money. But when you just look at where money is being spent versus invested in companies, it is a red flag that pops up for investors that are not familiar with this model. So that's one of the things I would encourage investors to understand is, one way to do it is kind of step back and understand, for the money that's going into the fund, what percentage ownership are you actually getting from each company that's being created? And how does that compare to investing in a traditional venture fund or investing directly? Are you getting a good deal? And if you are, dive in a little bit more.
Sure. Fantastic, Matt. Thank you so much for taking the time to help clarify. I suspect this will not be our last discussion. I just have a sneaking suspicion that I will find an excuse to bring you back to talk more about studios. Thank you, Matt. It's been a pleasure, and I look forward to talking to you soon.
Sounds great. Thanks, Omar.
Thank you, Matt.
Thank you.